So good afternoon, everyone. And we have Mr. Jairam Krishnamurthy as today's chief guest, and he will be sharing a presentation. And as we all know, the market is going through a very volatile time, and that is why we are listening from the expert today. Just to give a background about Jairam sir, he is a co-founder at Almus, and he is a head advisory and research at Almus, and he brings with him more than 40 years of experience in the treasury domain. And earlier, he has been in a senior position at public and private sector banks and also MNC banks. And until 2012, he was heading a corporate treasury of a very renowned diamond company. And today, Jairam sir will share with us about what's happening in the market on the commodity side, especially gold, and what's happening on the currency side. He has a short presentation, and while he is delivering the presentation, in case if we have any questions, we can drop in a message, and at an appropriate time, we'll unmute you and allow you to speak as well. But in case if you have any questions, please drop in a message, and we'll take that questions. Let us be more interactive, and without taking much time, I will give it to Jairam sir. Jairam sir, over to you, and we look
Okay.
forward from you, sir.
Sure. Thank you very much. Are you able to see my screen?
Yes, now we can see your screen, sir.
Okay. So good afternoon all, and it's a pleasure for me to interact with you and share with you whatever I know about the markets currently and what's likely to be seen in the coming days, weeks, and months in my assessment. So of course, let's start with what is currently the ongoing theme in the market, driver of the market, that is the Trump announcement on tariffs. And we all know that reciprocal tariffs were announced on the 2nd April, base of 10% and 50% of other countries' imposition, like India, if it is 54, it is 27, like that. For Europe, it is 20% versus 40%. That is the way it was announced. For, of course, China, it was much higher. And with China, it has been like US increases by some measure, China retaliates, and then again. So currently it stands at 145 from US side and 125 from China side. On 9th April, after a turbulent market, Trump announced 90 days. And also on the background that a lot of countries approached US for negotiating for a lower tariff. They paused implementation of the tariffs by 3 months. But this pause did not apply to China, of course. On retaliation side, India did not retaliate. Europe almost wanted to retaliate, but after the pause, they also held back retaliating. So that's the eventual. But then the volatility from this tariff announcement was too high. We saw the S&P 500 and the most watched global stock market, crashing by 10% after the announcement, and then similarly various other global markets also went through a very turbulent period. Of course, after the pause, they recovered about more than half of it. And then since then, it has been in a volatile period, all the stock markets. India did not fall as much as other markets because as we know, right from October, Indian market has been falling well before all these things happened in the global markets. And Indian markets had fallen about 16 to 17%. And the low that was seen prior to the tariff announcement has not been breached as far as India is concerned. So that is one stability as far as India is concerned. Now, China and US, the trade war continues. And that is the key thing that the market is still observing. There has been no indication that they are coming to the discussion or negotiation. But what we should be aware is that it's not easy to cut off US and China relations, because it is not just the international trade, but also it's there is a lot of cross-border investment between China and US companies operating in China, Chinese companies operating in the US. They have domestic sales. All those things may it will eventually impact both the countries in a big way. So now it's only a matter of time before these people also come into table. In fact, one of the large investors, Bill Ackman, has actually said that even for China, there should be a 90 days pause. If it does come, I think much more relief for the markets. Now, before we go into what's likely to happen and all that, we also look at how the US economy, latest Fed meeting showed, GDP somewhat lower compared to their earlier forecast, unemployment slightly higher. inflation also slightly higher, and then Fed funds rate was maintained. That means the rate cuts by the Fed, which has fallen by about 1% from 5.5 to 4.5%, is expected to be going lower by another 50 basis points. That is a Fed summary. But if you look at what the market is looking, there's a huge disconnect between what the market is seeing and what the Fed is saying. The inflation is likely to be higher by 1% if these tariffs are implemented. See, the tariffs are not going to be eliminated due to negotiation. For instance, for India, from 27 it may come to 15 or 10, but still that will be there. And similarly for all other countries. Therefore, even taking that into account, there will be a 1% impact on the inflation as per many of the estimates. And whereas the Fed says that it will be transitory, in the sense they say this will stay for some time and eventually that will adjust and the inflation will not be as high. But that is, we have to wait and see. Then there is a GDP number which we have been seeing, like 2.3% latest number announced for Q4. Compared to that, see, when we announce Q4 GDP number, it is a old number that is ending in December. We are already into April. So that's a very historical number. There is a estimate by Atlanta Fed, which announces GDP now taking into account day-to-day data of, if there is a consumer sentiment data or inflation number that is coming today, they take into account and announce some GDP now data that is actually at -3%. So varies 2.3% plus and 3% minus. So that's a huge disconnect. Market is also discounting 4 rate cuts. Fed says only 2 rate cuts. Unemployment rate, according to the market, will also go above 4.5%, whereas Fed is saying only 4.2%. That is the state of the economy. And if key drivers, I mean, US GDP, the consumption happens to be 70%, almost 70% of the overall growth. So that has actually been plunging. Consumer sentiment has been plunging. Consumer spending has been coming off. At the same time, consumers estimate inflation is at 4%. And currently, the current rate of inflation is around 2.8%. So that is something. What is the fallout of these tariffs? By way of chart, I can show it to you that this is the from the peak, the S&P 500 took a hit of almost 20%. So 20%, if it stays below 20% from the peak, it enters into a bear market. Bear market means you continue to sell. On all rallies, you continue to sell. Somehow, at the time when it entered 20%, that is when the 90-day pause was announced by the US government, and the stock market somewhat got saved, I would say. Since then, we have seen this green candle indicates that there has been a decent amount of bounce, and it has been trading around in a range since then. So stocks had a very big volatility. The volatility was across the markets. It's not just confined to US, because now we are a globalized world, and anything big happening in any part of the world, it impacts other markets also. While stocks have been somewhat controlled, and some stability has come, and even some more stability can come with some measures, tax cuts and all those things. The scarier thing is the bond market. Initially, bond yields dropped to a low of 3.86% 10-year benchmark bond yield. And from there, it has risen to 4.5%. Now, normally in a risk-off situation, when the stocks are selling off, or if there is economic crisis, then normally bonds get bought. When bonds get bought, yields come down. But here, with stock falling, even the bonds also fell, which means the yields went up. This is because US government, all of us know, that runs a huge debt of 36 trillion. Their fiscal deficit is over 6%. And with the tariff pause, or if the tariffs are implemented along with the inflation, if it comes and the growth slows down, their eventual fiscal deficit is not likely to be contained, because even if they collect the higher tariff, they are also having a plan to implement a tax cut for across the board, and that will take away the effect of tariff. So there will be no relief as far as the fiscal deficit is concerned. At the same time, consumption is falling, growth is expected to be negative. So when the growth is negative, obviously GDP is going to fall, and then there is no and because of inflation, Fed will not immediately cut rate also. These are the background under which the bonds have actually fallen and the yields have risen higher. and also huge positioning. So if you look at the market, overall market, US Treasury is the highest position in any market across the world. If you just to give you an idea, the global investors have about 18 trillion of investment into the US Treasury. That is one of the highest in any market. So that market, if it comes under threat, that is a very big scary situation for US government. It is not easy to control that market compared to the stock market, because yields going up, even if Fed comes and buys, how much will they buy? So those are the things, which is giving jitters in the market, and this can become much bigger also going forward. It can create, I don't want to scare you, but then it is not ruled out that we may have another global financial crisis type of situation which we had in 2008. If it continues, if the 10-year yield crosses 5%, that is very, very likely. So we are closely watching what the Fed will do and the US government will do. So just keep watching. Stock market is okay. Stock market will eventually, according to companies' growth and all that, they will have some downturn, and then they will come up also. Due to liquidity, they will come up. But not so with the bonds, because it's a very huge market, and it's not easy for, if the crisis comes, they'll have to take extreme measures. So that is something that we'll have to, and it will have an impact on all other markets and the dollar also. And finally, the other segment that got hit was the dollar, because again, historically, whenever there is a crisis in the stock market or a bond market, dollar gets bought, because that is the safe haven. So people think buying dollars and keeping in money in the US Treasury bills is the safest way. Now that has not happened this time. Actually, ulta has happened. We have seen the dollar drop by about 5% since the tariff announcement. It was at 1.08. That was the euro, and dollar index was around 105, and it has dropped to 99. Almost, that is a 5% drop that has happened. And importantly, it has broken through a psychological level of 100. And falling below 100 and staying below that is not a good sign for the dollar. So I would go to the extent of saying that both the dollar and the US Treasuries, they have actually lost the confidence of the global investors, at least till now. That confidence restoration, how it will happen, is what we need to say. And if it doesn't happen, then dollar will continue to slide, and there will be a huge sell-off in the bond market also further. And finally, the gold. Gold, as we all know, it has been going up since mid-23, and it's continued into the year 2025, and we have hardly seen any major drop. But when stock market fell by 20% from the peak, when people were incurring huge losses in other markets, they actually sold gold to make up for those losses. That was a temporary period from when it fell from 3150 to 2950. And then since then, it has made a new high. And gold will not have a downtrend unless we see the crisis being addressed well. It is overbought, but it will take some time for it. It will not go into a bear trend that easily. And in fact, if the dollar continues to drop, gold will continue to rise. This is the very strong view that we have. So overall, the stocks, if you summarize what has happened, stocks were overvalued even without the tariff issue, and hence they will remain weak for some more time. So you may see some recovery, but I think they will continue to remain in a range. They will not make a new high immediately with all these challenges around. All the major indices, technically speaking, there's in charts. If you have seen the charts, 200-day moving average is a very important benchmark line, and when stocks trade below that on a consistent basis, it continues to be on a softer side. So all the major indices excepting China and Europe, they remain below the 200-day moving average. The stress on the bond market is likely to intensify, which something that the US government cannot afford, because they are having 36 trillion of debt, and if the yield goes up, they have to pay that much higher interest on their bond. And this year, they have as much as 9 trillion of bonds maturing for rollover. And these 9 trillion bonds had an interest coupon of about 1 to 1.5%. Now the new interest rates, as per the market, will apply. If it is 4.5 also, it will be a big extremely difficult position for them to manage that. So that it's a very scary situation. What measure they will take, whether Fed will come and announce a fresh QE and say that I will buy unlimited amount of bonds, or whether he will come and cut the rates. If any of this is done, dollar will tank in a big way. Dollar losing massively is a reflection of diversification. Of course, we saw we have been talking about dollar diversification for quite some time, particularly since the Ukraine, they froze the Russian assets, and that has got a momentum after all these happenings. We look briefly at Indian situation. India has been quite stable. We know that rupee had been weakening till end February. We had touched a high of 87.95, almost 88. But since then, RBI has got in control of the situation, and quite a few initial strength was because of the accumulated flows. Everybody was long. Exporters were holding back, thinking that rupee will weaken further. Remittances were held up, and then even the NDF market had been running a huge long position. But RBI made initially a huge selling at 87.95, bringing it down to 86.40. Since then, every rally we have seen that the longs have been bailing out. We went as low as 84.95. This is because the long position or the weak the weak rupee view was negated because of some of the macro factors in India, which were seen improving, and at the same time, dollar index itself started falling. See, before the rupee recovery, the RER, the rupee's real effective exchange rate, was overvalued by 7%. But since then, it has dropped. It dropped to 102 when the dollar index started falling, and probably now it is closer to 100 also. There is no case for rupee to weaken. If you look at other factors also, trade balance turned into surplus in the month of February. We generally have a trade. See, that is when I say surplus, it is a combination of goods plus services. We have a 4 billion plus in the month of February. Of course, lower imports of oil, lower oil price, as well as gold imports coming down. They also helped this factor. Inflation has been coming down steadily after hitting plus 6% in the late 24, and then steady now below 4%, giving confidence to RBI to cut rates twice and support growth. We have while equity flows had been negative, we have had good flows into the bond market because India's yields at 6.5% is still very attractive, particularly when we are growing at 6% and still giving a yield of 6%. The global investors are really very attracted. So we have seen a shift in the Indian macros, which have actually stabilized the rupee. It is not just due to intervention by RBI. It is also, in fact, RBI's intervention has actually come down now. He is not intervening either on the selling side, on the buying side in a big way. But market is adjusting itself according to the fundamentals, and according to the fundamentals, rupee has been stable. Because if you look at one more factor, see, GDP growth also improved from third quarter to fourth quarter of 2024, from 5.7 to 6.2%. We generally talk about our current account deficit being 1.5%, and all that, and that has to keep the rupee weak. But actually, if you look at how we are having the remittances are actually, we are the largest receiver of private remittances for several years. And if you look at our trade deficit, that has been completely financed by the remittances. And even if with FII and FDI flows remaining very low during last year, FII flow was hardly 2 billion for the financial year 25, and also FDI were also much lesser. But the private remittances actually made up for most of our deficits, and though the stability of the exchange rate was also attained. Of course, RBI, people do expect, because RBI's reserves have come down from 700 plus to now 650 odd, they might buy. But I think that depends on dollar strength. If the dollar is continuing to drop overseas, then RBI may wait up, and if they may allow the rupee also to find its level now that the RER is not overvalued. So that is also another factor that RBI may not intervene much to protect the rupee strength unless it moves disproportionately too much on the downside. Otherwise, they will actually let the rupee find its level according to the market forces. And of course, this is the impact of the various sectors on in India by the tariffs, engineering goods, electronics. This is as per the data of 23-24 and 22-23. These are the sectors that are likely to get affected. So pharma, of course, initially they said it is exempted, but I think they will come out with some separate schedule for pharma also. So now my summary is that dollar index is likely to weaken. This is my message to this forum. The dollar index is likely to weaken. When I say dollar index, it is the dollar against major currencies. This is because US exceptionalism is waning. When I say exceptionalism, till last year, everything in US was good. Stock market was giving good return. Treasury is very safe, and US was growing at the best rate compared to all other major economies. That is now changing. Their structural deficit, the fiscal deficit of over 6% and likely to worsen, demands a weaker dollar. Even the new government is likely to lead to their policies like the retrenchment and cutting down of expenditures in various departments. In fact, they've closed down some of the departments also. All those things are leading to more unemployment and less consumption. So that will result in a slowdown in the economy, which means that eventually Fed will have to cut rates to support the growth, and dollar will become less attractive when the rates fall. Administration also prefers a weaker dollar, because that is one way in which they can address the huge trade deficit. Along with the negative factors of the dollar, you also see Europe and China economy are steadily improving now, which means that money is actually going to those countries, particularly Europe, which had been not favored by the investors for a very long time. Now we see that changing. Euro has been one of the major gainers of 1.01 to 1.14 is where it has moved in the last 6 months. So that is the kind of preference that people have given to euro as an alternative to the dollar. I won't say it has become a fully alternative to the dollar, but at least for the short term, the excess positioning that was there in the US, that has shifted to the Europe and European assets. Of course, US has also lost its leadership role because they have dissociated themselves with NATO, then WTO, and many other global organizations. They have actually lost that leadership role. So these are actually, and their policies have been unilateral. There is no discussion that happens. They are handling on the Ukraine war peace situation. All that has given some sort of a negative or a erosion in the confidence on the dollar. So that is the reason why I feel dollar is likely to weaken. Of course, we may see some consolidation around current levels because we are between 99 and 100. But if 99 breaks and holds, I think we will see a much bigger drop in the dollar. But we'll have to wait and see how things move in the coming days. Of course, one of the reasons why I feel dollar could be falling is also because a lot of capital has been gone into US in the last few years, and some of them are coming out. An estimate says that about 1.6 trillion of dollar is likely to move out of US in this year alone. So that's and another reason is S&P 500 in the US has been outperforming all other indices in the world, particularly the emerging markets, and that is likely to reverse. And this kind of cycle has happened many times. People shift from high growth EMs from US to high growth EMs and vice versa. This is a long cycle that happens. So possibly money will flow into EMs, particularly countries like India, which is growing at 6% on a consistent basis. So that is about the dollar. My bias is that dollar will weaken more, and when dollar weakens more, if you look at the dollar movement in the last 15 years, or let's say last 20 years, between 2001 to 2009, we had dollar falling. And at that time, even dollar fell by about 60%, and dollar rupee fell by about 20% from 49 to 39. And since then, dollar index has risen again by 58%, but dollar rupee has gone up by 100%. So from around 43, it has gone to 88. So rupee has weakened a lot more than other currencies against the dollar. Therefore, if we see a drop in the dollar index now, rupee is definitely going to go in the same direction. Of course, it may not fall to the same extent. Suppose euro if euro rises by 10%, dollar rupee will not go down by 10%, but it will go in the same direction, maybe 3%, 4%. Maybe something like 83 is achievable if dollar index goes to 95. That's my call. So overall, my call is for dollar to weaken. and that will have a downward influence on the USD INR also, well supported by fundamentals, negative fundamentals of US and positive fundamentals of India. Now, as far as the precious metals are concerned, if you look at the major driver of gold in the last 2 years and continuing into this year also is big buying. Starting from 2022, 23, and 24, central banks buyings have reached a different level compared to all what it was being seen in earlier years, and that has been supporting the gold prices. Another factor supporting the gold is that, if you look at the performance of gold relative to all other assets, it has actually given much better return. If you take in many countries which are mentioned here, gold, even in India, equity market in 13.4%, gold returns 12.2%. It's not bad at all, although it is less than that. At 12.2 also, you would like to buy gold and keep it. So in all other countries, it has given much better return than the equity market. So, holding gold has not been a bad asset portfolio in your, in your investments. And also, if you look at the ETF, gold ETFs, they are, continuously attracting more and more money, and that is also another indirect way in which the investors are supporting the gold prices. So gold, finally, to conclude on the gold, it is been on an uptrend for much longer period than euro or any other currency. Therefore, it is a bit overbought in the short term. It can see some consolidation. I think it will not go below 3,000. It may move between 3,000 and 3,300 in the next few months. It is very likely because there may be some profit taking at higher level and all that. Only way in which it can fall much more is if there is a big bond market crisis and people are incurring billions of dollars of losses. Then they will shift to booking profit on the gold also in a big way, and they will make up for those losses. That is the only situation in which I see gold falling below 3,000. Otherwise, gold will be in this range for some time. But eventually, when the dollar index falls through 99 and 95, which I expect will happen over the period of next 1 year, gold will eventually move towards 3,300. Sorry, 3,300 is very near. 3,500 is very much likely.
Excellent, Jairam sir. I think you shared some very, very informative insights for all of us here. And in the audience, we have a lot of the audience from the G&J sector, especially jewelry side. And I think I'm just trying to summarize what you have said. While anyone, if you have any questions, please raise your hand and we'll unmute you and allow you to ask some questions. Let us be more interactive. But just summarizing for what you said. On the currency side, you are expecting the dollar index to go to 95, and at the same time, the dollar weakening. And while the rupee might weaken, but not at that extent as what it was in many years. But you see a probability of 83 also coming. Is that correct?
Yeah, directionally it will be the same, but it will not fall in the same proportion as the dollar index.
As a dollar index, but that's where most of the exporters here that we have in terms of when we see export, and if we are seeing a dollar weakness, that's something that from a risk management point of view we can look at managing it. And since in the US bond also you said that US has globally $18 trillion of treasury from the global side, and any turbulence on the bond markets will lead to a big havoc out there. That's something that we all have been watching. And if there is a correction in the bond market, that is reflecting in the gold as well. You said that gold is in the range of $3,000 to 3,300 in the near term. We don't see it falling below 3,000. And only if there is a big bond crisis, that people would want to take their profit in the gold, and then the gold can go below $3,000. But overall, we don't see that. In case of otherwise, we see gold in the upward direction as well only. And from a medium to short term or medium to long term, we see it going to 3,500 as well. And overall, we've seen historical returns of also gold, which is equivalent to the equity index, especially in India and all the other countries as well. So gold, And why am I talking also about gold is because we have a lot of audience who are into G&J and they have a gold risk exposure as well here.
Okay.
Happy to have any questions here while Jairam sir has summarized it extremely well for all of us from the currency side and from the gold side. We see a range of gold of 3,000 to 3,300, but that's what we are expecting. Any questions? Happy to have it here. Jairam sir, while we have some questions, I have a question. When we see dollar rupee in terms of the export, and currently the prevailing premium is about two and a half, two quarter or two and a half. Do you see that any change? Do you see these yields expanding further?
Are you talking about dollar premium, dollar pay premium?
Yeah, dollar rupee premium.
So dollar pay premium, see if the dollar, so long as the dollar yields remain higher, the
Hmm.
premium will shrink
Hmm.
because the differential will be lower. But eventually, as we have seen in the earlier cycles also, if the
Hmm.
Fed cuts rates, see if the crisis becomes big, there are two things that are possible. Fed may come and suddenly massively cut interest rate to control the yield. And secondly, they may abandon the quantitative tightening and announce a fresh QE, because there is a huge pressure already even without this crisis, there is a huge pressure on Fed from the US government to cut rates, bring down the rates. And if the bond market crisis happens, it is very likely that they will come and announce a QE. And when that happens, US yields will drop, US rates will drop, and that will increase our premium also. At the same time, the spot rate will fall. So you have when of course the spot rate falls due to US weakness, the premium will go up, but premium may not make up to the same extent as the spot. So it is always so. As a strategy, I would say currently we are at 86, and even between 86 and half and 87, I would think that exporters should take advantage of even the current premium to hedge themselves.
So that's a good direction, sir. 86 half 87 is something that exporters can think of starting to hedge. We have one question from Mr. Yomesh Shah. Sir, if we have a 2008 crisis situation, what happens to gold and dollar rupee?
So if see rupee, first let me deal with the rupee. So the rupee will get definitely will happen to fall only when there are huge outflows. Now, if the crisis is so big that the FIIs they have already taken out a lot of money from India. Almost 41 billion was taken. 35 billion was taken out from between September and February. A lot of money, and since then it has not been restored also, it is remaining at the same level. If the crisis becomes so big that they decide to sell off even further, then rupee will weaken, because rupee is affected by two things. One is sentiment, secondly the flows. If the flows become extremely negative, rupee can. So a crisis of that nature can happen. So far Indian economic system has been safe, financial system has been safe, RBI has been in control of things. So it's not, but at the same time, suppose there is an institutional failure in the US, like Lehman Brothers or something like that, and that can actually lead to, rupee again temporarily weakening towards 87, 9, or even 88 possible, if there are one way selling on the rupee or one way buying on the dollar rupee. So we have to see what kind of crisis it becomes. If it is same as 2008 and institutional failure and FIs continue to take money out, that is likely. And as far as the gold is concerned, as I said, if the crisis is too severe and everybody incurs huge losses, gold may get sold off temporarily. In COVID time also, we have seen that when the stock market fell from, I think in India, stock market fell from somewhere around 17,000 to 7,500. And at that time, global markets also fell by about 20 to 30%. At that time, gold got sold, and initially to make up for the losses. So there might be a situation where gold will see some profit taking itself, but eventually Fed will have to cut rate. They will not be able to sustain when their growth is going to be lower, when they want a lower rate for financing their debt, and when they want to save their financial system and the financial institutions. If the crisis arises, they will cut rate massively. Even nowadays, 1/4% cut by Fed looks big, but in a crisis, 1% cut can happen overnight. So these are things, in US, the volatility of the rates is very high. So when the crisis situation comes, so when they cut like that, gold will easily rally into new highs.
Noted, sir. That was helpful, sir. And Yomesh bhai, I hope you got the answer to your question. Janab sir, we have one more question. We have Aryan Bair who wants to ask us a question. Can we unmute him?
Hello, sir. Can you hear me?
Yes,
Yes.
I can.
Yeah, so thank you for the informative session. I have a question. While you were reflecting on the tariffs on different sectors that US have put on,
Mm.
But do you think that slowly we'll move on from a sector to sector based tariff rather than a blanket tariff on every country? Since even on electronic components, US have exempted certain tariffs. So can you highlight on that?
Yes, definitely. I think US will see US is going to be selfish. Okay, so whatever goods they need critically, and they cannot do away with, they will keep the tariffs lower. Pharma, that is why they excluded it initially, and even some of the electronic components and all, they are very much dependent. Like I think, for example, iPhones. Most of them, even India is manufacturing a lot of iPhones. So US is not producing as much as they consume. So these may be attracting a lower tariffs, and the related countries also, particular depending on the product which they are exporting, there will be a differentiation. It will not be a blanket for across all products. It won't be.
Thank you, sir.
Thank you, sir.
And of course, it also depends on the kind of negotiation. See, with different countries, they have different agenda. Like with Japan, they think that yen is artificially kept too weak to get a trade advantage by the Japanese authorities. Now they are actually negotiating with Japan to strengthen the yen. So yen has been, if you look at yen and all other currencies, yen has weakened a lot more compared to all other currencies. It went from 101 somewhere near COVID to 159, I think. So that kind of weakness is actually because they kept the interest rates at negative and all those things that they want to address US. So that way they have agenda with each country. With India, they may have a different. They may want India to buy more oil and gas from US, or more defense equipments from US. So it will be all a quid pro quo. It's not just the product based; it's also country-based negotiation that will decide the rates.
Got it. Thank you so much. Do we have any other questions for Jairam sir? Okay, great. So Jairam sir, it was really wonderful, the insights that you shared. Okay, I think we have one more question coming from Arun Kumar. Where can we see gold in the coming 60 days? I think sir has partly answered this also, sir. Maybe you can just briefly again get to Mr. Arun Kumar.
I mean, I think it's extremely now. I think in the last few months to 1 year, 2 months, I think everybody has bought gold, and it is like who wants to buy more in the hope of someone else buying at even higher level. So I think unless central banks come and buy gold at these levels in a big way, it's not likely to. I think if you ask me, next 60 days, gold may be more in a range. It has actually lost the momentum. It is not falling. It is still rising very gradually, much at less momentum. It is rising. It is not rising in the same momentum as euro or other currencies. So next 60 days, if you ask me, I would put it as slightly above 3,300 on the upper side, and the lower side, I would put it at 3,150.
Okay, that is a good view, sir. Mr. Arun Kumar, I hope Jairam sir
This is
addressed.
subject to we not seeing any major crisis on the bond market.
Yeah, as you rightly mentioned, if there is a big crisis in the bond market, investors will go and sell or book their profits on gold, and that is one scenario where we can see gold going below 3,000. But otherwise, we can see this range of 3,000 in the next 60 days. We mentioned 3,150 to 3,300 range bound. We see a dollar weakness, so that might relate in the long term to a rupee gold movement, sir. While the gold might remain in the same range, with the dollar weakness and the rupee strength, the gold INR might have a certain impact. That is what we see. But yeah, so that's something that is a good. I think we have two more questions. So one is from Dipti Vaidya. Sir, in short term, 1 to 2 months, and in long term, 3 to 6 months, what would be the trend of dollar rupee and gold trend? Sir, again, I think you have answered, but maybe you want to just readdress this to Dipti.
So the gold I have answered already, whatever I have told. As for the rupee is concerned, I think I expect it to be in 85 to 87 range, so long as the dollar index stays around 99. But if there is a Fed rate cut or a new QE, the range can shift to 83.5 to 85.5 or 83.5 to 86. So very likely that, dollar rupee range shifts to the lower side in the coming days, particularly if there's a Fed rate cut. We cannot see a situation where US dollar will rally to previous highs immediately in any way, because I think emerging markets have already seen, including India, have already seen a lot of weakness in their currencies over the last 2 years. In India, right from the time of Ukraine war, dollar rupee has been steadily going up only. So I think as far as the global investors are concerned, their exposure to India has reduced, and very likely that if there is a lower rates in the US, dollar rupee will go down. So initial range 85, 87, I think it will hold, and eventually when dollar index breaks down further and coupled with the US rates coming down, we will see the range shifting lower actually.
Great, sir. So thank you so much, and it was a really an insightful session. While we started off with the tariffs, how US and China are managing the trade war, and then you went to bond index, how the bond yields have been rising, how what is there in the US bond market, and how it could lead to another financial crisis, and how it has an impact on the dollar. You mentioned, and what is the impact on the gold you mentioned. I think with that, I think we have, sir, one more last question while I was summarizing, but if there is one more question, if we can address, it is from Mr. Yomesh Shah. If the yuan devalues, will it affect the rupee?
Yeah. So if the yuan devalue, so if is a big thing there. Recently, we saw the offshore yuan going to a new high at 7.42, and since then it has come off to 7.30. This is after a statement issued by the Chinese government, Chinese authorities rather, saying that they will not use the currency as a tool for retaliation. So since then, actually yuan strengthened. So even if you think that they may not say what they're going to do, but reality is that if we can see, China is trying to become a major player in the reserves also, or you can say major global player for yuan trade and also for increasing reserves in yuan and all those things. That being the case, they wouldn't like to see their currency too volatile. They would like to maintain stability of that currency. So my view is that yuan may not devalue, but then if they are forced to devalue for any reason, rupee will definitely follow it. So I think because we have so much of imports from China, and we are also looking to keep our trade balance in check, and I think we in general we will have periods when rupee appreciates against yuan also. But yuan devaluation means if I say a 10 to 20% move in the yuan, I think rupee will follow that. But my view is that yuan may not devalue to that extent.
That's a very, very fair point. As you mentioned, China is not using the currency as a tool to manage it. In case it does, then yes, of course, the rupee will follow. But as you mentioned, rupee, if the dollar index goes to 95, you can see rupee going to 83.5, 84. That is a range that you mentioned. Gold in the same range, 1,000 to 3,300. So extremely insightful session. And maybe if there are some more questions, maybe I'll reach out to you or connect with you personally, and take that link forward. And this kind of session in this kind of a market where things are so changing dynamically every day, this session does help all of us, all the business entrepreneurs, and this gives an insightful session. And that's Jairam sir for you. And please reach out to us for any other further questions. And we look forward to having a session maybe sometime next month to take these things forward. Thank you so much, Jairam sir, and thank you so much, everyone.
Thank you all. Pleasure. It's been a pleasure. Thanking you.